Good morning, everyone. Well, Draghi finally gives in. ECB President Draghi has signaled that the ECB is finally going to take some action against low inflation. Speaking on Saturday after the IMF meeting, he said, "The strengthening of the exchange rate requires further monetary stimulus." The message coming out from the meeting was that a cut in interest rates is likely at first, possibly into negative territory. Only after that would the ECB attempt a quantitative easing program. As for when the easing measures are likely to begin, press reports say that the Bundesbank is unlikely to support any moves until the ECB revises its economic forecast in June. However, a lower than expected inflation print for April could prompt an earlier response, as happened last November. So the date to watch is April 30th, when the preliminary Eurozone CPI for April is released, or the day before when the German CPI is released. In any event, Draghi's comments should be the key for a weaker euro going forward. The clear divergence between the Fed and the ECB is likely to pressure the euro and support the dollar, in my view. The dollar is, in fact, starting the week generally higher against both G10 and emerging market currencies, although the euro isn't as weak and gold isn't as strong as I would have expected after A, the Draghi comments, and B, the worsening crisis in the Ukraine. Euro sterling, for example, has barely changed from Friday's opening levels, which suggests to me that the euro has further room to fall. The dollar also gained against most emerging market currencies, although the likelihood of further easing in the eurozone should keep carry trades in fashion and support the emerging market currencies, at least against the euro. So investors who are thinking of putting on EM carry trades should consider putting them on against the euro, in my view. Friday's U.S. data were relatively positive for the dollar, continuing a string of good U.S. numbers. The producer price index rose more than expected, hinting at a buildup in inflationary pressure that could make the Fed more willing to countenance higher rates. And U.S. consumer sentiment hit a 9-month high. This follows last week's better-than-expected jobless claims, which fell to a cyclical low. Today's news should also be dollar supportive. Retail sales are forecast to have accelerated in March, bringing some good news about consumption. And tomorrow we get the CPI for March, which is expected to accelerate on a year-on-year basis. That may change some people's view of how quickly the Fed's likely to raise rates. Speeches by Fed Chair Janet Yellen on Tuesday and Wednesday will, of course, be closely watched for any clues on this matter, and particularly if she clarifies the confusion over whether the FOMC stock phrase that a highly accommodative policy will remain appropriate for a considerable time after asset purchases and really means 6 months, a number that didn't show up in the recent FOMC meeting minutes. And on Wednesday, we also get the Fed's Beige Book, which will give the first hints of how the FOMC is likely to view the economy at its meeting on April 30th. There are no major European indicators out today. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.